How can government policies affect the market? Keep watching to find out.
Price ceilings are a legal maximum price at which a good can be sold. Price floors are a legal minimum price at which a good can be sold. Price ceilings can be either binding or non-binding. Notice how in a non-binding price ceiling, the market's equilibrium point is not affected, but in a binding price ceiling, the market has a difference between quantity supplied and quantity demanded. That difference is called a shortage, and to find the shortage quantity, take quantity demanded minus quantity supplied.
Price floors are similar to price ceilings, except that instead of a maximum, they set a minimum. Just like price ceilings, price floors can be binding or non-binding. In a binding floor, the market price must equal the price floor, and the difference between quantity supplied and quantity demanded is called surplus. It's important to note that economists usually oppose price ceilings and floors because they are rarely efficient.
Our next topic is producer and consumer surplus and how taxes can affect surplus. Producer surplus is the amount a seller is paid minus the cost of production. Consumer surplus is the amount a buyer is willing to pay minus the amount a buyer actually pays. In a supply and demand curve, you can determine producer and consumer surplus by calculating the areas above and below the equilibrium point.
Excise taxes are taxes on specific goods like alcoholic beverages or cigarettes. In this graph, we can see both consumer and producer surplus, deadweight loss, and revenue the government makes from an excise tax. To decide who the burden falls on when a tax is set, you must determine the elasticity.
If a good is perfectly inelastic, the consumer bears the entire burden of the tax, but if it's relatively inelastic, the burden falls more on the consumer. If it's perfectly elastic, the producer bears the entire burden of the tax, but if it's relatively elastic, the burden falls more on the producer. If a good is unit elastic, the burden is shared equally between producers and consumers.
Here's an FRQ.
Pause here and try to answer the FRQ. For Part A, 1 point is earned for calculating the total producer surplus as 1/2 times 20 times 20 equals 200. For Part B, 1 point is earned for stating that imposing a price floor at 16 is ineffective and will not create a surplus or a shortage in the market because it is set below the equilibrium price, so it's not binding. And for Part C, 1 point is earned for stating that imposing a price ceiling at 12 will create a shortage because quantity demanded is greater than quantity supplied, so it's binding.
Thanks for watching.